racing to an IPO. Ride-hailing service Lyft priced its initial public offering last night at $72 a share. That values the company at more than $24 billion. This company is going to start trading today on the NASDAQ. Lyft setting the stage for rivals like Uber, reportedly looking to go public next month at a $120 billion valuation. Joining us right now is EquityZen co-founder and chief revenue officer Phil Haslett. And Phil, it's good to have you on the program.
Good to be here.
Thank you so much for joining us. So your reaction to what we're seeing this year in terms of all of these IPOs kicked off by Levi's last week and Lyft today?
Yeah, so we're pretty excited here at EquityZen that 2019 is going to be a banner year for IPOs compared to 2018. We had a bit of a lull the last few years, but we think a combination of low market volatility and, quite honestly, a lot of these companies growing to be 10, 12, 13 years old finally are going to finally test the markets here.
Is this a good thing for the markets?
Yeah, I think so. You know, it gives an opportunity for investors to participate. It gives a little more liquidity to the stock. It gives the companies an opportunity to use their own stock to acquire other businesses as well.
Yeah, the interesting aspect is that it seems like every single unicorn is stampeding out of the enchanted forest and deciding to go public for the first time when the capital markets were there to keep them private. So either it's validating the gig economy or they're trying to get out at the height of the market. And I think that's what everyone's trying to assess, because you see Lyft has lost an egregious amount of money last year, right? I mean, it's like, why would you invest in a company that's losing so much money, right? And they don't even have any guidance on when they're going to become profitable. So I think that's the biggest issue. But my issue that I have with these companies is the dual class structure, right? Why would I buy a company where the founders have all of the control, yet they're cashing out?
Which
Sure.
Levi's has too, by the way.
All of them are doing it.
Sure. Definitely a founder-friendly market, I'd say, right now in 2019 to kind of get away with that type of structure. One of the things that Lyft has going for it is that it's got two co-founders that are still running the business, and they've done it successfully. Yep.
Yeah, well, how did that do? Not well.
Well, the thing I think that Lyft has as well is that within the transportation sector, they're able to point to the fact that over the last 10 years, this nice guy image has actually built up the business quite steadily. And I know that a lot of people talk about the losses, but actually if you count the number of companies that are publicly traded that have $2 billion in top line and growing 100% or more, there's only 8 companies. So Lyft is in kind of uncharted waters in a new territory.
The 9th is coming out, right, if you think about that with Uber. And then you've got Pinterest is coming as well. So, I mean, there's...
Well, it's going to be a record setter, actually. Yeah. We've got a number of the names here, Pinterest, WeWork, Peloton, Slack, all on the pipeline to go public. There's also all this money on the sidelines, right? Venture capital, private equity. James.
Yeah, there's not really a need to go public. And I guess in terms of you have so much private money willing to fund it, but these companies now, whether it's maybe they think it's a market top or maybe it's just a better environment to go public now.
That's right. That's right. You know, there's so much private capital kind of sloshing around. And one of the reasons why we started our business was to have a private market to trade those shares so that you would actually still have liquidity. But I think actually you're going to see some more companies come through still with this year, particularly as there's enough liquidity in the public markets and this appetite. You know, low volatility is obviously the greatest time to go public as a tech company.
But in comparing Lyft to Snap, I just want to point out, Lyft customers actually have money to actually pay for the rides. That was the problem with Snap, is that, oh, well, young people love Snap. Yeah, but they don't even have jobs. Like, they're teenagers who aren't working. So I know, I was like, they have to rely on their mom and their dad to pay, to buy anything that might be advertised on the service. I never understood. We were negative on Snap from day one.
I think one of the exciting things about Lyft actually is that it's going to be the first time you can invest in a pure play transportation company that looks this different and kind of part of the gig economy. You know, if you want to make that type of investment now, you would have to invest in something like GM or Ford, and the chance to do that in a company that's going to try to handle transportation from start to finish is going to be a unique story.
Well, I think they have a cleaner business model than Uber, too.
And they don't have the baggage of Uber.
Right. They don't have the baggage of Uber. Also, it's a pure play on the transportation because Uber is putting their hands in every single different little basket, right, with Uber Eats and you name it, across the board,
Taco
scooters.
Bell.
And by the way, most people are not expecting an autonomous car on the road, I'm saying without a human in it. For at least 10 years.
That's right.
But do you think all the supply is going to be an issue for markets? I mean, how much demand in terms of new money from investors do we have coming in to sop up some of this supply? I'm wondering if it's going to actually send the broader markets. It could be a supply issue for the broader market.
Yeah, one of the reasons that Lyft probably wanted to go first, in addition to getting out in front of Uber and controlling that narrative, is that, you know, they do get to take up part of that portfolio from Fidelity, from T. Rowe Price, from these money managers that maybe later in the year say, you know what, kind of taken on a lot
and
here.
Lyft doesn't have the same number of mutual funds invested in the company in the private market that a lot of these other unicorns do. That Fidelity is really one of the only big mutual fund companies that's invested in Lyft before it goes public.
That's right.
So there's this fear of missing out.
Yeah.
But among these other big institutional investors.
That's exactly right.
Well, the important thing is the ages of these companies is so far along, right? The median age of a unicorn going public right now is 12 years old. Go back to 1999. The median age was 4 years old, right?
Yeah, that's a good. That's
and so they've stayed in the private market for a long time, and they have gotten the Fidelities, and these institutional investors have already invested in them. Why would they invest when they're going public?
Great story. I love it. Phil, it's good to have you on the program.
Thanks for having me.
Thank you so much. Phil Haslett there.